Everyone knows the fastest way to make money in the market is to learn from the legends. Warren Buffett, Howard Marks, Peter Lynch, Ray Dalio. These are the names that light up every investor's imagination. They've built empires from patience, discipline, and wisdom, turning the stock market into a lifetime masterpiece. It's easy to get inspired by them. You read The Intelligent Investor, you study Buffett's letters to shareholders, you follow Ray Dalio's economic principles, and you think, if I just follow what they did, maybe I can achieve what they achieved. And honestly, that's not a bad idea. They've proven themselves over decades, through crashes, bear markets, inflation, bubbles, and still came out on top. They are living proof that it is possible to build wealth through the market. But here's the harsh truth, and it's one that most people never want to face. If you're a retail trader, trying to invest the same way they do could be one of the biggest mistakes of your life. Because before you copy Warren Buffett, you need to ask yourself one simple question. Who are you? Do you have the same advantages, the same access, the same control over capital? Let's be real.
When Warren Buffett buys a stock, he isn't buying a few hundred shares. He's buying a piece of a company, sometimes big enough to influence its decisions, meet its executives, and access private data long before the public ever sees it. Howard Marks manages billions through Oaktree Capital. He doesn't log into a trading app and wonder what's moving today. He gets calls directly from investment banks, fund managers, and corporate boards. Peter Lynch ran Fidelity Magellan, one of the largest mutual funds in history, with an entire research team feeding him information 24/7. Ray Dalio built Bridgewater Associates, the world's largest hedge fund, backed by supercomputers, economic models, and hundreds of analysts running scenarios across global markets. Now compare that to a typical retail trader: a laptop, a brokerage account, and a few hours after work. The difference isn't intelligence, it's infrastructure. They play a different game. They have access to information you will never see, tools you will never own, and relationships you will never build. So when you try to invest like Warren Buffett, you're not following the legends. You're trying to run a marathon wearing someone else's shoes, 2 sizes too big, on a track you've never trained for. That's why so many people enter the market full of hope, quoting Buffett, buying undervalued stocks, and still lose money. Not because the strategy is wrong, but because it's wrong for them. So before you copy another famous investor's playbook, stop and ask yourself the only question that truly matters. Who are you? Because once you understand that, once you define your position, your strengths, and your limits, only then can you start building an approach that actually fits you. And that's exactly what we're going to talk about in this video.
Part 1. Don't copy Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. It's one of the most quoted lines in investing, and for good reason. Warren Buffett turned those words into one of the greatest investing philosophies ever written. They sound simple, powerful, and timeless. But here's what most people forget. It works because Buffett isn't you. 1. Institutional versus individual reality. Warren Buffett runs Berkshire Hathaway, a holding company with total assets exceeding $1 trillion as of 2024. He's not trading from his laptop at night or reacting to headlines on CNBC. He's managing a financial empire with direct access to the inner circle of corporate America. When Buffett considers investing in a company, he doesn't just look at a chart or read the news. He can literally pick up the phone and call the CEO. He can fly to their headquarters, sit down with the board, and get insight into the company's long-term plans, insights that no retail investor will ever see. He also controls the size of his trades in a way that changes the game entirely. When Berkshire buys into a business, it's not a short-term bet. It's often a strategic partnership. Sometimes he owns 10%, 15%, or even more of the company.
That ownership gives him influence, it gives him information, it gives him stability. Now let's look at your side of the table. You have a brokerage account, a laptop, and maybe a few $1,000s to invest. You don't get a private phone call from the CEO when things go wrong. You get the same press release everyone else gets, often hours or days after the institution's already acted. That's not a level playing field, and pretending it is, that's where most retail investors lose. 2. The illusion of buying the dip. Buffett's philosophy tells you to buy when everyone else is scared. That sounds smart, and it is smart when you know what's really going on behind the scenes. But for retail traders, this idea often becomes a dangerous trap. Imagine a great company, consistent profits, healthy balance sheet, maybe even a dividend payer. One day, the stock drops 30%. Social media lights up. It's cheap now. People quote Buffett, "Be greedy when others are fearful." So, retail investors rush in, thinking they're following in his footsteps. But here's what they don't know. Sometimes, that price drop isn't just panic, it's a signal. Maybe there's an accounting issue that hasn't been made public yet. Maybe a key product is failing, or management knows earnings will collapse next quarter. Maybe institutional investors, who have access to that information before you do, are already unloading shares quietly. By the time retail traders see the headline, "Company faces internal investigation," or "CEO resigns amid scandal," the stock has already fallen another 20%, and that bargain they thought they were buying has turned into a falling knife. That's why being greedy when others are fearful only works when you know why others are fearful. Buffett knows. He has the resources to find out. You don't, not in real time. And that's the difference between professional investing and emotional reacting.
3. The advantage you'll never have. Big institutions, hedge funds, pension funds, and Berkshire-level conglomerates play an entirely different game. They have entire teams of analysts, economists, and data scientists working around the clock. They get access to real-time institutional data feeds that retail brokers don't offer. They meet with management, attend closed investor briefings, and receive information through private channels that retail investors can't access legally or practically. They also manage risk differently. If an institutional portfolio drops 10%, it's a rounding error. They have capital buffers, diversification, and hedging strategies. But for a retail trader, a 10% loss on a concentrated position could mean losing months or years of savings. And that's why they can afford to buy dips and hold for a decade. You can't, not without proper systems, discipline, and liquidity. When you try to mirror Buffett's portfolio, buying value stocks, waiting years for them to recover, you're playing a game designed for billion-dollar funds. He can hold through a bear market. You might need that money in 6 months. So when you try to copy Warren Buffett, you're not just adopting his strategy, you're borrowing his weapons, but stepping into a battlefield you're not trained for. You can admire Buffett, you can learn from his mindset, but you cannot copy his methods. Because everything that makes Buffett's strategy work, scale, access, capital, and influence, is exactly what retail investors don't have.
And that's the first hard truth you need to accept if you want to survive in the market. You're not Warren Buffett. And that's not an insult. It's actually the beginning of wisdom. The moment you stop pretending to be him, you free yourself from trying to play his game. You stop chasing value without context. You stop buying dips without understanding why prices fall. You start seeing the market for what it truly is. Not a place to imitate billionaires, but a place to master your own edge. Because the path to financial freedom isn't about copying Buffett. It's about understanding who you really are and building a strategy that fits your reality, not his.
Part 2. The path retail investors should follow. So if copying the billionaires doesn't work, what does work for you? That's the question every individual trader eventually faces. Because once you stop chasing Warren Buffett's shadow, you're left standing in the reality of your own situation. Limited capital, limited access, and limited time. But that doesn't mean you can't win. It just means you have to play your game. And history shows there are two paths that have consistently worked for retail traders. Ordinary people who learn to turn the market into a source of real wealth. 1. Learn from those who started like you. Don't study billionaires who run conglomerates. Study those who began exactly where you are, alone, small, undercapitalized, but hungry. Take Mark Minervini, for example. He didn't start with millions. In fact, he began with a small account trading out of his apartment in the 1980s. He wasn't managing institutional money or calling corporate executives. He was studying charts, price behavior, and market psychology. Through trial and error and brutal losses early on, he developed a data-driven method centered on momentum, relative strength, and strict risk control. By focusing on technical behavior rather than insider information, Minervini turned a modest starting account into multi-million-dollar performance and became the U.S. investing champion in 1997 with a return of 155% that year. Then there's William O'Neill, the founder of Investors Business Daily and creator of the Can Slim method, a blend of fundamental and technical analysis that emphasizes growth stocks showing strong earnings, sales, and price momentum. O'Neill didn't have access to corporate boardrooms either. He built his fortune by identifying patterns that repeated over decades, from the price breakouts of IBM in the 1960s to Apple and Amazon decades later.
And before both of them came Jesse Livermore, often called the boy plunger, one of the earliest market wizards. He started with just $5 in the early 1900s, working as a, quote, boy in a bucket shop, tracking prices by hand. Livermore didn't have research teams, analysts, or financial models. What he had was an extraordinary ability to read price and volume. All three of these traders, Minervini, O'Neill, and Livermore, prove one thing. Success in the market isn't about access or privilege. It's about understanding how the market moves and adapting your behavior accordingly. They didn't succeed because they knew secrets. They succeeded because they built repeatable systems around observation, discipline, and execution. That's the first path. Learning from people who played the same game as you, under the same rules, and still won.
2. Focus on price and volume. Now, let's talk about the second path, mastering the only two signals that never lie, price and volume. Livermore's timeless quote, "There is nothing new on Wall Street, there can't be, because speculation is as old as the hills," isn't just poetic. It's the foundation of technical trading. Because the truth is, human behavior in markets hasn't changed in over a century. Fear and greed still drive every decision. No matter how complex financial models get, the footprints of big money always show up the same way, in price movement and trading volume. Here's how it works. When insiders or institutions know bad news is coming, before it becomes public, they start selling quietly. That selling creates downward pressure. Prices slip. Volume rises. To the untrained eye, it just looks like volatility. But on the chart, it's the beginning of a decline that's often confirmed weeks later by the headlines. The same is true in the opposite direction. When large investors expect something positive, a strong earnings report, a big contract, or a new product launch, they start accumulating shares early. Prices rise on higher volume even before the news breaks. That's why technical traders say the chart knows before you do.
For retail investors, this is the ultimate advantage. You may not have access to private information, but you have access to the reflection of that information through price and volume. The market always reveals its secrets to those who know how to read them. You don't need to guess why a stock is going up or down. You don't need to wait for the news. By the time the reason becomes clear, the move is already over. That's why traders like Minervini or O'Neill didn't waste time trying to understand every headline. They focused on how the market reacted. Because in trading, the reaction matters more than the reason. The real edge for a retail trader isn't information, it's interpretation. You win not by knowing more, but by seeing earlier. That means learning to spot institutional footprints, those sudden spikes in volume, clean breakouts above resistance, and strong price moves confirmed by relative strength. These aren't coincidences, they're signals, proof that someone big is buying or selling. And that's all you need to follow.
In the end, the path for retail investors is simple, but not easy. Forget about trying to outsmart billionaires. Forget about copying strategies built from massive funds. Instead, learn from those who played your game. Traders who turn small accounts into fortunes by mastering patterns, price, and discipline. Focus on what you can see, price, and volume, because they're the only truths the market always tells. You don't need to know why something is happening. You just need to recognize that it's happening and act on it before the crowd does. That's your real advantage. That's your edge. And that's the only path that truly works for you.